Okay, hello. My name is Tanner, and today I'm going to be going over something real quick. I'm going to show you guys I think the most important calculation problem from Chapter 9 to know for the exam. And yeah, so Chapter 9 is regarding risk and the cost of capital. We are introduced to WACC in this chapter, which is WACC stands for the weighted average cost of capital. Takes into account the financing structure of the business. So whether it's, you know, financed primarily by debt or by equity, those are all factored into WACC. And yeah, so let's get into it. The problem we're going to do here is this one here, number 2. So you can read it. I'll read it out loud as well. A company is 40% financed by risk-free debt. So don't be scared off by risk-free here. Just ignore that. So it's 40% debt. Interest rate, aka the cost of debt. So the rate on the debt is 10%. The expected market risk premium is 8%. So the expected market risk premium, we learned that from previous chapters. So that's equal to the return on the market minus the risk-free rate. So that's going to be 8%. And then the beta of the company's stock is 0.5. So it wants us to calculate the cost of capital in this case, which is just R. And then it also wants us to calculate the after-tax weighted average cost of capital, assuming the company pays tax at 35%. So I'm going to take you through both these calculations here. The first of which we are going to calculate the cost of capital. So in order to do that, we need to first calculate the cost of equity. And if you remember from previous chapters and with CAPM, or the capital asset pricing model, we learned that you can calculate the return on the stock by basically taking the risk-free rate and adding on to that the product of the beta, the stock beta, times the market risk premium. And we're given all that information here. So let me go ahead and open up a MS Paint here and just show you guys how to do this really quick. So the first thing, we're going to calculate cost of equity, and that's equal to the risk-free rate plus beta, the equity beta, times the market risk premium. Oh my gosh, I cannot draw for my life. Okay, so that's what we're going to solve for here. So it's equal to, we're given 10% for the risk-free rate, or the interest rate on the debt, and then the stock beta is 0.5, and the market risk premium is 8%. It's really hard to draw periods in Paint here. So you do the math here. You have 0.05 times, or wait, I'm sorry, 0.5 multiplied by 0.08 is going to give you 0.04, and you add that onto 0.10, it's going to give you 14%. That is our cost of equity here. Okay, 14% for the cost of equity. All right, moving on. So the actual formula for the cost of capital, we need to know the cost of debt, which we do know. We need to know the weight of equity, the weight of debt, and the cost of equity. And you basically, once you know all those, you plug them into the formula, and you get the before tax cost of capital of the company, the whole company. This is taking so long. I'm going to do this because it's probably way faster. Well, I have a better idea for next time, to take this and do this and then just plop it on there. But for now, go back to the newbie strats. Okay, so I'm going to tell you how to calculate this R here. So the company cost of capital is equal to the debt over value, that's a D, multiplied by the cost of debt plus the equity over value multiplied by the cost of equity. that's going to give us our company cost of capital before tax. So in this case, we have, as stated from before here, we have a 40% debt structure, and we have a 10% cost of capital, or cost of debt. And then we have a 60% equity ratio, and we multiply that by our newly calculated 14% for the cost of equity. And it's going to give you I can't, I'm so bad at this. 12.4%. That is the before tax, assuming all equity finance. Okay, continuing on. I ran out of video space there, but we just calculated the company cost of capital, not the WACC. So we didn't factor in taxes there. Now we're going to go ahead and do that. Let's go ahead and just do that real quick. So for WACC, it's a little different, the formula here. The formula, you're still going to have the debt to value, that's a D. And you're going to multiply that by the cost of debt. However, for WACC, you actually, the debt in this case is tax deferrable. So we multiply that again by 1 minus the tax bracket, which in this case is 35%. And then we're going to add on the cost of equity multiplied by the equity over value ratio. So WACC is going to be, our debt to value is still 40%. Our interest rate on the debt is still 10%. And we're going to do 1 minus the 35% tax bracket that we're in, which will give us 0.65 in this parentheses here. And then we add on our calculated cost of debt, which is 14%. And you multiply that by the equity over value, which is 60. And then that will give us 11% for WACC here, or 0.11 or 11% for the weighted average cost of capital. So I can show you really briefly how I did these, how I did this calculation here. Let me show you. So for the right side, the equity side, we do 0.14 times 0.6. It's going to give us 0.084 for the right side. And then for the left side, we have 0.40, multiply that by 0.10, the interest rate, multiply that by 65%, and it'll give us 0.026. Add that onto the right side, 0.84, and you get 11% for WACC. So that'll conclude question number 2 for chapter 9, risk and the cost of capital. Next chapter will be chapter 12, and that is regarding agency problems. So tune in for that one.